The Intelligent Investor by Benjamin Graham is often regarded as one of the most important investment books ever written, with its core principles influencing generations of investors, including Warren Buffett. Key concepts in The Intelligent Investor. Value investing. Graham's philosophy revolves around the concept of value investing, seeking investments that are priced lower than their intrinsic value. Rather than trying to time the market or chase after the latest trends, value investors focus on the underlying worth of companies. By purchasing undervalued stocks, they believe they can generate long-term gains as the market eventually recognizes the true value. Margin of safety. This is perhaps Graham's most famous concept. The margin of safety means buying investments at a price that is significantly lower than their intrinsic value, providing a buffer against unexpected market downturns or company-specific risks. The larger the margin of safety, the less risk an investor faces. Graham emphasized that investors should never overpay for stocks, as even good companies can be bad investments if purchased at the wrong price. Defensive versus enterprising investors. Graham divides investors into two categories: defensive, passive investors. These investors want to avoid the stress of actively managing investments. They prefer a simple, hands-off approach, often focusing on index funds or well-diversified portfolios of blue-chip stocks and bonds. Their goal is stability and modest growth, prioritizing safety over maximized returns. Enterprising, active investors. These investors are more hands-on and take a more active approach in selecting and managing investments. They are willing to spend more time researching and analyzing stocks, bonds, and other investment opportunities. However, Graham notes that this approach requires greater knowledge, skill, and effort and may lead to higher potential returns or losses. The investor's mindset. Graham stresses the psychological aspect of investing. He warns against emotional decision-making, particularly fear and greed, which can cause investors to make impulsive choices. Investors must maintain a long-term perspective and stay rational, even when the market is volatile. He introduces the concept of Mr. Market, a metaphor for the stock market's irrational behavior. Sometimes the market is optimistic and offers high prices. Other times, it's pessimistic and offers low prices. A rational investor should ignore market emotions and focus on the fundamentals. Avoid speculation. Speculation, buying stocks based on short-term price movements or tips rather than fundamental analysis, is a key point of criticism in Graham's philosophy. He argues that speculation is a gamble, not investing. True investors seek to understand a company's underlying value, its earnings power, and long-term prospects. This approach contrasts sharply with traders who rely on market trends or short-term predictions. Mr. Market, one of the most enduring concepts from The Intelligent Investor, is the idea of Mr. Market. Graham introduces this imaginary character to illustrate the market's volatility and irrational behavior. Mr. Market shows up every day offering to buy or sell stocks at different prices. Some days he's overly optimistic, and other days he's down in the dumps. Investors should treat Mr. Market as a partner who may offer opportunities to buy low or sell high, but not to be influenced by his mood. The investor's job is to remain rational and unemotional, only taking action when the price is right according to the intrinsic value. Investing versus speculating. Graham draws a clear line between investing and speculating. Investors are those who seek a reasonable return with a margin of safety, while speculators are those who rely on market trends, price fluctuations, or predictions. Speculating often involves higher risk, and Graham cautions that the vast majority of people who try to speculate end up losing money in the long run. The role of bonds and diversification. Graham stresses the importance of diversification, both in terms of asset classes, stocks, bonds, etc., and within stocks themselves. He recommends that investors keep a balanced portfolio to manage risk, typically with 25 to 75% in bonds, depending on an individual's risk tolerance and age. Bonds provide stability and income, while stocks offer growth potential. Security analysis. Graham introduces a systematic approach to analyzing securities, stocks, bonds, etc. He advocates for a focus on the company's financial health, including its earnings history, debt levels, and future prospects. Investors should be wary of high-flying stocks that promise great returns without sufficient backing from solid financial performance. Investors' role in market efficiency. Graham does not believe in market timing, where investors try to predict short-term market movements. Instead, he advocates for a long-term view, investing in undervalued assets and holding through market ups and downs. He believes that in the long run, the market tends to reflect a company's true value, even though it may be volatile in the short run. Core philosophy. Graham's fundamental philosophy is that an investor should be cautious and deliberate. Investing isn't about chasing after the latest stock tips or predicting market trends. It's about understanding the businesses behind the stocks you buy, ensuring you're paying a fair price, and having a margin of safety in your investments. Investors should stay rational, ignore the noise of the market, and avoid being swayed by fear or greed. Impact. Graham's work has had an enormous impact on modern investing. Many of his principles were later adopted by some of the world's most successful investors, such as Warren Buffett, who considers Graham his mentor. The Intelligent Investor is a timeless guide to developing an intelligent, rational approach to investing that can weather market cycles and help build long-term wealth. In essence, The Intelligent Investor is a guide for anyone who wants to approach the stock market with a disciplined, thoughtful, and long-term strategy, focusing on safety, avoiding speculation, and making decisions based on solid financial analysis.